Most retirees walk out of their last day of work feeling free and walk straight into a tax trap the IRS never warned them about. The paycheck system that handled your taxes for 30 years just disappeared, and what replaces it is entirely your responsibility. If you miss even one of these 10 rules, the penalties are real, the dollar amounts are significant, and the IRS will not accept "I didn't know" as an excuse. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. Here is something that surprises almost every retiree when they first hear it. During your entire working life, you never had to think about taxes in real time. Your employer calculated exactly how much to withhold from every paycheck, sent that money directly to the IRS on your behalf, and handed you a W-2 at the end of the year that summarized everything neatly. The system was invisible, automatic, and almost effortless on your part. The moment you retire, that entire infrastructure disappears overnight. There is no employer. There is no automatic withholding. There is no system quietly running in the background making sure the IRS gets paid on time. What replaces it is a set of 10 specific obligations the IRS expects every retiree to manage independently, and the agency assumes you already know all of them. The first obligation is estimated tax payments. When you are no longer receiving a paycheck with withholding, the IRS requires you to pay your taxes in 4 installments throughout the year. These are due in April, June, September, and January. If you miss them or underpay, the IRS charges a penalty that currently runs between 7% and 8% annually on the amount you should have paid. That is not a fee. That is not a suggestion. That is compounding interest working against you every single day you are late. The IRS offers a safe harbor rule. If you pay at least 90% of what you owe for the current year, or 100% of what you owed last year, you avoid the penalty. But you have to set this up yourself. Nobody will remind you, and nobody will do it for you. The second obligation involves Social Security withholding. Many retirees assume their Social Security benefits arrive tax-free. They do not, at least not for the majority of recipients. You can request voluntary tax withholding directly from your Social Security benefit by filing Form W-4V with the Social Security Administration. This form takes approximately 5 minutes to complete, and you can choose to withhold 7, 10, 12, or 22% of each monthly payment. If you skip this step and your income crosses certain thresholds, you will owe a large lump sum at tax time with no payment system in place to cover it. The third obligation is understanding provisional income, which is the formula the IRS uses to determine how much of your Social Security benefit is taxable. Most people have never heard this term, and that is exactly the problem. Provisional income is calculated by adding your adjusted gross income, your tax-exempt interest, and 50% of your Social Security benefit together. If that combined number exceeds $25,000 for a single filer, or $32,000 for a married couple filing jointly, up to 50% of your Social Security becomes taxable. If it exceeds $34,000 for singles, or $44,000 for joint filers, up to 85% of your benefit is taxable. Here is what makes this especially painful. Those thresholds were set in 1983 and have never been adjusted for inflation. That means, as Social Security benefits have grown and retirement account balances have increased, more retirees cross those lines every single year. According to recent estimates, approximately 56% of Social Security recipients now pay federal income tax on their benefits. In 1983, the number was far smaller. The formula did not change. Your retirement income grew into the trap. The fourth obligation is a deduction that most retirees are not claiming and most tax software is not flagging automatically. Beginning with the 2025 tax year, there is a new $6,000 senior bonus deduction available to taxpayers who are 65 or older. This deduction is temporary, tied to legislation passed in 2025, and it phases out at higher income levels. But for the retirees who qualify, it represents a meaningful reduction in taxable income that could lower your tax bill by hundreds or even thousands of dollars, depending on your bracket. If your tax preparer or software does not ask about this deduction by name, you need to bring it up yourself. The IRS does not automatically apply it. The responsibility falls entirely on you. The fifth obligation is required minimum distributions, and this is where the stakes get serious in a hurry. The IRS requires you to begin withdrawing a minimum amount from your traditional IRA and most employer-sponsored retirement accounts each year starting at age 73. The amount is calculated based on your account balance and your life expectancy factor as determined by IRS tables. If you miss your RMD or withdraw less than the required amount, the IRS imposes a penalty of 25% on the amount you failed to withdraw. That penalty has been reduced from 50% in recent years, but 25% is still a significant hit. There is also a 2 RMD trap that catches first-year retirees. If you delay your very first RMD to April 1st of the following year, which the IRS permits, you will then be required to take a second RMD by December 31st of that same year, potentially doubling your taxable income for one calendar year and pushing you into a higher bracket. And this is what nobody tells you clearly enough. Every single one of these 5 obligations comes with a deadline, a dollar amount, and a penalty. Missing any one of them is not a paperwork inconvenience. It is a financial cost that compounds over time and affects your Medicare premiums, your Social Security taxation, and your overall retirement security. There are 5 more obligations still to cover, and what comes next is where most retirees lose the most money without ever realizing it. If this is making sense so far, go ahead and hit that like button. It genuinely helps this channel reach more people just like you. The 6th obligation every retiree must understand is the Qualified Charitable Distribution, or QCD. If you are 70 and a half or older and you plan to donate to charity, there is a powerful strategy that most retirees overlook entirely. Instead of withdrawing money from your IRA and then writing a check to your favorite charity, you can instruct your IRA custodian to transfer the money directly to a qualified charitable organization. When done correctly, that transfer counts toward your required minimum distribution for the year, but it does not appear as taxable income on your return. You essentially satisfy part or all of your RMD requirement without the tax bill attached to it. The annual limit for QCDs is $105,000 per person as of 2026. For retirees who are charitably inclined and are already being pushed into higher tax brackets by their RMDs, this strategy can save thousands of dollars annually. But the money must go directly from the IRA to the charity. If you take the money first and then donate it, the exclusion does not apply. The sequence matters, and the IRS is precise about it. The 7th obligation involves Roth conversions, specifically during what financial planners call the gap years, the period between when you retire and when your required minimum distributions and Social Security benefits begin at full force. During those gap years, your taxable income may be unusually low. That creates a window where you can convert portions of your traditional IRA into a Roth IRA at a lower tax rate than you would face later in retirement when RMDs are stacking on top of Social Security income. A Roth IRA grows tax-free and has no required minimum distributions during your lifetime. If you convert strategically during the gap years, paying tax now at a lower rate to avoid higher taxes later, the savings over a 20 or 30-year retirement can reach tens of thousands of dollars. This is not a loophole. It is a fully legal tax planning strategy that the IRS has built into the retirement code. But it requires intentional action. It requires running the numbers in advance. And it requires understanding your future income picture well enough to make an informed decision today. And this is where most people stop reading, stop watching, stop paying attention. But the ones who stay are about to understand something that could completely change how they see their money and their retirement tax exposure for the rest of their lives. The 8th obligation is IRMAA, the Income-Related Monthly Adjustment Amount. This is the Medicare surcharge that a surprisingly large number of retirees trigger without any warning. Medicare Part B and Part D premiums are not flat rates for everyone. If your income exceeds certain thresholds, Medicare charges you a higher premium, sometimes significantly higher. For 2026, the surcharge begins when your modified adjusted gross income exceeds approximately $106,000 for single filers or $212,000 for joint filers. Here is what makes IRMAA so dangerous for retirees. It is based on your income from 2 years prior. So if you take a large IRA withdrawal in 2024, the surcharge hits your Medicare premiums in 2026. You may not even remember that withdrawal by the time the bill arrives. A single large Roth conversion, a home sale, or an unexpected distribution can push you into a higher IRMAA bracket for a full 12 months. The surcharges can add hundreds of dollars per month to your Medicare costs, and once triggered, they are very difficult to reverse without a qualifying life event. Knowing this before you make large financial decisions in retirement is not optional. It is essential. The ninth obligation is one that sounds almost too simple to matter, but the IRS takes it seriously. You must keep your mailing address current with the IRS at all times. The agency sends penalty notices, audit letters, deadline reminders, and refund checks by mail. If you move after retiring, which millions of Americans do, and you forget to update your address using IRS Form 8822, critical correspondence goes to the wrong address. You will not know a penalty was assessed. You will not know a deadline was missed. And when the IRS eventually tracks you down, which it will, the accumulated interest and penalties can be far worse than the original issue. This step costs nothing and takes 5 minutes, but skipping it has cost retirees thousands of dollars in avoidable penalties. The 10th obligation requires retirees to revisit the standard deduction versus itemized deduction decision with completely fresh numbers. The tax landscape shifted dramatically when the SALT deduction cap, state and local taxes, was raised to $40,400 for most filers beginning in the 2025 tax year. For retirees in higher tax states who previously itemized, this change means the math needs to be recalculated from scratch. In addition, taxpayers who are 65 or older already receive an enhanced standard deduction. For 2026, a single filer aged 65 or older receives a standard deduction of approximately $16,550, and a married couple where both spouses are 65 or older receives approximately $30,700. Layer on top of that the new $6,000 senior bonus deduction, and the comparison between standard and itemized becomes a genuinely complex calculation that could go either way depending on your specific situation. Running those numbers incorrectly could mean leaving thousands of dollars on the table, or paying a higher tax bill than the law requires. The pattern connecting all 10 of these obligations is the same. They each have a deadline, they each have a dollar amount, and they each carry a penalty for getting it wrong. The IRS designed the retirement tax system assuming that every retiree would take full responsibility for learning and managing all of it. The problem is that nobody hands you this checklist when you walk out of work for the last time. The resolution is not complicated, but it does require action. The first step is to sit down with a qualified tax professional, specifically one who specializes in retirement tax planning, not just annual filing, and walk through all 10 of these obligations before December 31st of your first year of retirement. The first year sets patterns that can follow you for the next decade. Getting those patterns right from the beginning saves far more money than correcting mistakes after the fact. The second step is to set up your estimated tax payment schedule immediately if you have already retired and have not done so. You can pay directly through the IRS direct pay system at IRS.gov with no fees and no paperwork. Set calendar reminders for April, June, September, and January. Treat these payments the same way you treated your mortgage payment, non-negotiable and on time. The third step is to request your Social Security statement, review your provisional income calculation, and file Form W-4V if you are not already withholding taxes from your benefit. This single step eliminates the most common surprise tax bill retirees face in their first year out of the workforce. I want to be clear, I'm not here to sell you anything. I'm here because this information changed the way I think about money, and I want it to do the same for you. The IRS is not going to call you and explain these rules. Your former employer is not going to send a follow-up guide. The responsibility for your retirement tax situation now rests entirely with you, and the retirees who take that responsibility seriously in year one are the same ones who preserve more of their savings, pay less in unnecessary penalties, and sleep better at night knowing their financial house is in order. Fear is a reasonable response to a system this complex. Confusion is understandable when nobody explained any of this to you during your working years. But confusion is not a permanent state. It is a starting point. Every one of the 10 obligations covered in this video has a solution, a form, a deadline, and a strategy attached to it. None of them require you to be a tax expert. They require you to be informed, proactive, and willing to ask the right questions before the penalty notice arrives instead of after. Retirement was supposed to be the reward for decades of hard work. The IRS rules are not designed to take that reward away, but ignoring them can do exactly that. The retirees who thrive financially in retirement are not necessarily the ones who save the most. They are the ones who managed what they saved with the same discipline and attention they gave to earning it. You now have the 10 rules. You now have the context, the deadlines, and the dollar amounts. What you do with that information from this point forward is entirely up to you, and that is exactly how financial freedom is supposed to work. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.